Hi there, my name's Jill Kay from Cashbox.Global, and welcome to today's session and the first of our express info sessions on our latest product. Full rationale is available on the link and on our website, which is www.cashbox.Global. Should you have any questions or wish to set up a call for more information, please pop us an email on support@cashbox.global and we will send that through to you. If you're new to structured notes, we do suggest that you attend one of our introduction to structured notes sessions, as it's important for you to understand how and why these products work. Again, you can email us on support@cashbox.global for dates. With that, we need to just do a little bit of housekeeping. A reminder that we don't provide advice. This is a session on product information, and we always encourage you to do your own research and due diligence before making any decisions. We are happy to chat to financial advisors as well. Past performance is not a reliable indicator of future performance and shouldn't be used to assess the future returns or risks. With that, let's get into the detail. Today, we're going to look at a fixed income note issued by Bbva with a target return of 10.8% in GBP and 11.6% in USD per annum. The strike date for this note is the 6th of September. So, why fixed income notes make so much sense right now? The search for sustainable and predictable cash flow has become increasingly more difficult against the backdrop of rising global interest rates. This sounds a bit counterintuitive, but in context, with USD, GBP, or Euro interest rates coming off such low bases, real yield is still far below anything meaningful to an investor looking for stable returns that are not subject to a high degree of risk associated with the financial markets of today. But the news isn't all bad. It appears that central banks, although they will continue their upward trajectory cycles yet again before they top out at some point down the road, or possibly even sooner. Effectively, cash returns on typical bank products are still set to underperform against inflationary pressures. When looking at the double-digit UK inflation rate, traditional bank instruments still offer no respite. In the investment world as we know it, we are conditioned that if you want to achieve higher returns, you must accept higher risk. This isn't necessarily true. Regular investors have just been excluded from opportunities that deliver above average returns with capital protection in various market conditions. With this note, you can invest for a fixed income while managing the risk and costs and achieve above average returns with your capital protected as well. Whilst rates may vary by region and sums invested, you would be hard pressed to find anything exciting in the form of a guaranteed income in the retail market today. Say your high street bank pays you 1.5% per annum on a fixed term deposit. You could potentially double that up to 3% per annum with a 10-year bond commitment. However, with Cashbox.Global's institutional levels, you can receive over 10% per annum in either sterling or US dollars from Europe's strongest investment banks. Let's take a look at the underlying basket that has been selected. The sector selected in this note is e-commerce, and the underlying basket that Bbva will be observing for this contract are leaders in their sector, namely Amazon, Etsy, Mercado Libre, and Shopify. From the graphs, you'll notice that all four shares have pulled back from their all-time highs and are now offering better valuations. Each of them are strong operators in their respective geographic and sectorial areas. While Amazon, Etsy, and Shopify are well known, let's take a look at Mercado Libre because they are less known. Mercado Libre hosts the largest online commerce and payments ecosystem in Latin America. They are centered on enabling e-commerce and digital and mobile payments on behalf of their customers by delivering a suite of technology solutions across the complete value chain of commerce. Their market capitalization runs to $44.49 billion. So what are the details of the note? The issue is Bbva, which is a Spanish institution established in 1857 and based in Madrid and Bilbao. It is one of the largest financial institutions in the world, with a presence mainly in Spain, South America, North America, Turkey, and Romania, They actually operate in 24 countries. The product is available in both GBP and USD, with a fixed return of 10.8% per annum in sterling and 11.6% per annum in US dollars, which is paid out quarterly as long as the product is active. The maximum term for this product is 4 years, and an autocall feature has been included with a trigger at 100% of the start price that goes live after 12 months. What this means is that after 12 months, should all the underlying stocks making up the reference basket be at or above their start price, the product will mature early, at which point the investor will have received all coupons to that point and full capital will be returned. If any of the 4 stocks making up the underlying basket fall below their start value at this point, the note will continue and the investor will receive the quarterly payment. Every quarter after the first 12 months, the same test will be applied until it either autocalls or reaches maturity in 4 years when the product closes. Until either of these 2 scenarios take place, coupons will continue to flow quarterly, regardless of where the underlying stocks are. We've covered the underlying stocks in the reference basket, and more detail is available in the rationale, as I said, is on our website. Your capital is protected to maturity. So why does it say protected to 50% of initial value? What this means is that while your capital is protected for the term of the note, in the event that the product doesn't autocall or mature early, at the very last observation in year 4, the test will be applied, and as long as the underlying stocks have not more than halved their start price, your full capital will be returned. Even if the underlying stocks drop by 50%, you will receive 100% of your capital back. The note is already open for investment, and while the last day to invest is the 5th of September, this is subject to inventory availability. With the limited options for fixed income rates at anything close to this, we do anticipate capacity to be taken up quickly. So if you are interested, I urge you to send us an email with your interest as soon as possible. Again, you can send it through to support@Cashbox.Global. The minimum investment for this product is $10,000 or 10,000 sterling. As always, on the fact sheet, you have the important dates, which show you the actual date of the observations and payments. In the event of a date falling on a weekend or a bank holiday, it'll move to the first business day after that. You'll see that there are no observation dates for the first 3 quarters, but there are payment dates. This is because the coupons cannot be interrupted until the product autocalls or matures. The first opportunity for an autocall is at quarter 4, which is after the 12 months. Thereafter, there are observations every quarter until maturity to test for an autocall, which is set at 100% of the start price. To look at this in action on a graph, we have the start price against which everything is measured on the left-hand side. For each quarter that passes, an income coupon will be paid out. From month 12, or the 4th quarter, the autocall feature goes live. And at any quarter thereafter, should the underlying stocks be at or above their start price, the product will close early and your full capital will be returned, having received all the coupons to that date. If this doesn't happen, the product will continue until maturity with coupons paid every quarter, regardless of how much the stock might drop. At the very last observation, the 50% capital protection test will be applied. So even if the stocks drop by up to 50% of their start price, your full capital will be returned in the event of the product lasting the full term and not auto-calling before that. Let's take a look at why it works. Well, banks have no money of their own, and they need to attract large deposits to grow their balance sheets and improve their profitability. For this, they look to institutional investors like pension funds and other large private investors to place substantial deposits with them. In order to attract these large deposits, the bank needs to offer investors something in return, namely specified above average returns as well as capital protection, even if the markets are flat or declining. You could think about it as investing with airbags and seatbelts. This is done through a bank contract called a structured note, where all terms and conditions are defined, and as well as the protection and payment dates and the conditions. These investors don't like surprises, so everything is detailed in the contract with no opportunity to change. They also want no surprises, even if the market is flat or declining. So what are the things that you should consider? 1, the bank must be comfortable that they will be able to cover the cost of what essentially is borrowed money and make a healthy profit for themselves. This they establish through research, backtesting, and forward projections. From an investor's perspective, they must be comfortable with the strength of the issuing bank and also have a view that the underlying stocks are not likely to halve in value in 4 years' time, which is the end of the term. Taking a quick look at how to access the investment and flow of funds. As you know, we operate in a highly regulated environment, and every contract must pass the risk and compliance of each party, which is exactly the type of protection investors would want. To invest in the note, you need an international investment platform, also known as a trading or custodial platform. Cashbox.Global are platform agnostic, but if you don't have one, again, you can drop us an email on support@cashbox.global, and we'll send you a list of platforms that will hold structured notes. From a funds flow perspective, funds only flow from the investor to their platform and to the issuing bank, and coupons and return of capital flows back the exact same way. There are no middlemen between the investor and their investment. No funds ever flow through Cashbox.Global. With regards to fees, there are no fees on the product. The only fees that there are involved are the ones charged by your investment platform, which you choose yourself, and 100% of your capital goes into the investment. If you do have a platform, be sure to check their fees and ensure that they are market related. The product fees are actually built into the product. That's why there are no additional fees that are needing to be paid. We are now at the end of our time together, and in quick summary, this product has a target return of 10.8% in sterling per annum and 11.6% per annum in US dollars, paid out quarterly. Your coupons are fixed and guaranteed until the product autocalls, which is an early maturity, unless it goes to full term. An autocall will be triggered when all the stocks are above their start price, but only from the 12th month or the 4th quarter, and will be measured thereafter every quarter. In closing, thank you for your time, and for any information, please email us on support@cashbox.global. We also invite you to follow Cashbox.Global on LinkedIn and Facebook for new product updates and informative posts on structured notes. Thanks so much. Bye.